Hey guys, it's Dave. Welcome back and thanks for watching as always. Today we just had my number 2 space stock, which is Planet Labs, have their earnings, or I should say yesterday, but the results are coming in today, and it actually looks pretty grim. The stock has dropped about 30%, so that's almost full 1/3 the value of the entire company has been destroyed in a single day. And so if you're anything like me, you've probably been wondering, what the heck is causing this? Why did this happen? And luckily for you, I have a easy answer. And the easy answer is it's because I just bought it last week. So, of course, the investing gods have decided to completely slash the valuation. And you're all just collateral damage. So sorry for all that. But jokes aside, though, obviously it's pretty rough if you're a big Planet Labs investor. So I thought I would just take a quick look at what's happened in this most recent quarter. One bright side, at least, is that I've just taken a small position in the stock so far. So if I still am confident in the overall future of the company, I could always add a lot more shares at an extremely discounted price compared to when I bought just last week. Obviously, I'm still a bit new when it comes to Planet. I'm not as much of an expert on it as, say, Rocket Lab, so I'm still learning as I do make these videos, and I hope you bear with me and we go through learning about the company together. Before we dive into the earnings results, please consider hitting like and subscribe if you haven't already. Every subscriber helps out so much, and I always enjoy talking to you guys down in the comments below. With that out of the way, let's dive into Planet Labs results. Okay, so first of all, just some high-level numbers for you, just to give you the headline results for the earnings. We had revenue numbers, $52.7 million. That's up 31% year over year comparing to the same quarter last year. The net loss, because the company is still not profitable yet, that is down 22%. The net loss was only $34.4 million. So they continue to head in the right direction in terms of those net losses, getting smaller and smaller for each quarter. That's also generally a good thing if you're trying to get to profitability. Cash remaining on the balance sheet is $376 million, a pretty solid amount when you consider they're burning about $30 million per quarter. They have a pretty significant cash runway ahead of them, and they don't have any debt on the balance sheet either. So one of the things I've always liked about this company is that they still seem to have a very solid balance sheet. Now, this is where it gets a little bit bad. We have the financial year 2024 guidance. They've lowered their revenue guidance from before it was $248 million to $268 million. Now they're lowering it down to $225 to $235. This is obviously bad news. We're expecting to make, $20+ million less than they were before this quarter. So clearly something has happened to make them think they're going to be making less money. In terms of adjusted EBITDA loss, they were saying they're looking at $37 to $47 million adjusted EBITDA loss. They're now projecting for the financial year to have $58 to $67 million in losses. So more losses in terms of adjusted EBITDA and lower revenue. And that's where you get into trouble, where the analysts, the investors, the people covering the stock are having to update all their models in terms of what they think the company's going to make. And that's where we trigger this selling spree that we've been seeing today. And just to show you how nice and painful it is in a stock chart, of course, we have me buying somewhere probably over here. I forget the exact day. But then it's pretty obvious when the earnings came out. We just have basically a dropping off a cliff here all the way down to about $3.4 per share. Now, if you're still bullish on the company, this could be a great buying opportunity. But if you think the story has changed, then that's something you would have to take into consideration. I'm trying to figure out which is the case here, and we're going to go through that together. So some highlights from Q1 based on their earnings presentation. They had a growth rate of 31% year over year. That's pretty good. I mean, I'm not going to complain about it. We have seen higher growth rates from other companies like Rocket Lab and stuff like that. 31% year over year, though, you can't really complain about that too much. Strong visibility. This is one thing I've loved about the stock from the moment I started looking into it, is that over 90% of their revenue comes from annual or multi-year contracts. They have a high predictability, unlike, launch being lumpy and stuff like that. 93% recurring revenue and 56% non-GAAP gross margin is pretty good, especially when you compare it against 45% in the fiscal Q1 of 2023. So a year ago, gross margins are moving in the right direction, something you really want to see when the company is trying to get profitable. You really need to see those gross margins continue to march on higher. In terms of the balance sheet, as I said previously, on our top line items, we have $376 million. So pretty solid balance sheet. They have a long cash runway ahead of them. Now, revenue growth, this is actually accelerated. So from Q1 of 2022 to Q1 of 2023, that was only 26% year-over-year growth. This is 31% year-over-year growth. So from that side of things, looks pretty good that the revenue growth is not just being sustained, but is actually being accelerated. Of course, this is just for one quarter, so that story may be different if you're looking at like Q2, Q3, how fast they were growing last year. It's probably going to be higher than this 26% number, but we'll have to go back and look at the numbers on that. Annual revenue growth in millions, up 46% year over year. Again, quite good. And this is, of course, annual, not just quarterly. Customer base, 903 customers as of the end of the quarter. That compares to, I believe it was in the high 800s before this quarter or last quarter. I think like maybe 890, something like that. I think we'll see a bit later on, but do still have customer growth. So that's clearly not a disaster scenario. Customers are still being added as opposed to being subtracted. And then the outlook, this is where we got into some trouble because the outlook was being lowered again. We're seeing 225 to 235 for the full year. Their revenue growth percent, we're looking at 18 to 23%. Gross margin, 52 to 54%, which is pretty decent growth. And then the big one here is the adjusted EBITDA is going to be pretty negative. So why are they adjusting all these numbers down? Well, I did listen to the conference call, and they're saying, over the past few weeks, they're seeing revenue come in a lot lighter than they were expecting. So they could either treat this as a blip or model for it and predict that this may be kind of a sign of things to come. And they're kind of taking that second path, thinking that, okay, this is probably a sign of how the year is going to continue and that we should adjust our guidance accordingly so that people's expectations are not too high. The biggest blame is really on the macro picture here. They're kind of saying that most people are trying to rein in their spending in the face of what could be a recessionary environment, and a lot of companies are doing likewise as well, as in fact, indeed, Planet Labs themselves are doing, and we're going to get to that in just a minute. So just a few more takeaways here from the earnings call, a few things that I wanted to mention. So we already went over this, but basically what I would like to say is that the company mentioned they are lowering their guidance because they are encountering, less revenue than expected. So what they're going to be doing in response to that is focusing on efficiency themselves and reducing their own spending. So they're not going to spend as much money on the lower value customers and focus on those high value, high return contracts and the high value customers. So they're going to try and rein in their own spending, kind of reduce the spend to fuel future growth, and still target to become profitable at the same time by spending less instead of growing their revenue more. So that's a bit of the trade-off they're making. When you spend more, you kind of expect that will pay off in the future, and then you'll earn more in the future. They're going to spend less to try and still hit profitability at the same time. So again, their customer base did not increase massively. They went from 822 to 903. Still a good cash position. Still plan to be profitable by the end of the year. They're going to curtail spending in order to make up for the lower revenue, as I said. One thing I did find interesting is that clearly management got the memo, along with pretty much every other tech-related company out there, that AI is the big buzzword right now, and everyone wants to try and say AI as much as they possibly can in their earnings call to let the analysts and investors know, oh, they're going to ride the AI wave as well and into the future. We did hear the CEO mention AI so many times, talking about how these AIs can leverage their vast data set, and that really when it comes to AI, you need to have data in order to make that AI work and be valuable, and they have the biggest amount of data when it comes to Earth observation. And they're working with more AI firms, and that they think they'll drive a lot of value in the future. So very much on the talking point here compared to, the rest of the tech world talking about AI. I just found that kind of interesting. We also heard the CEO use the word solid to describe the quarter several times. That's not usually a ringing endorsement, something that's going to fill an investor with excitement when you say, oh, it was a solid quarter, it was a solid result. You're not hearing it was amazing, it was better than expectations. When you say solid, that just means like, okay, we kind of got in there and barely met our expectations. Let's move on to the next quarter. But definitely nothing to get excited about when you hear language like this being used in an earnings call. And indeed, some of the other language used on the call wasn't really too exciting. More around like getting through tough times than kind of building up the company. So what do I think about these results? Well, as I said, I'm still learning a lot about the company. I've made just a small position. In my experience, when you see these massive drops after a piece of news is announced or earnings results are released, they overshoot. And they overshoot to the downside when it's bad results, and they overshoot to the upside when it's good results. So that being my experience, I have a feeling they probably have overreacted to these results. Now, I'm not going to say it's good that revenue's coming in lower than expected, although the CEO did mention that they have a lot of really exciting contracts in the pipeline, and now the pipeline is not signed, sealed, and ready to go. The pipeline means it's kind of being worked on, and they're trying to come to an agreement with these companies. So there could be a lot of big, exciting contracts in the future, but it's not guaranteed. A bit of a mixed bag when you think about it like that. So will I add more stock? Not positive yet. I might very well do that because I don't think the overall thesis on the company has changed completely from these results, and the fact that they're still committing to get profitable at the same time is really important to me. When I look at investing in an unprofitable company, I do want to know when they will become profitable. I don't like to see that date slide, and the fact that they're still sticking to their guns on that one is a good sign for me overall. I think efficiency is important. Renewed focus on it is always welcome. We look at the stock like Meta. I don't know if you remember a while back, the Meta stock was absolutely crushed. Mark Zuckerberg came out and started talking about efficiency, talking about saving money and near-term profitability. And analysts really loved that, and the stock has more than doubled since then. So perhaps with this focus on efficiency, with this focus on reduced spending, in the long run, that'll be good for the company to tighten their belts and be more lean and mean and efficient. And hopefully in the future, they'll continue to the faster revenue growth that we were expecting. Let me know what you think down in the comments below. Are you buying more shares on this dip? Are you extremely angry that the stock has plummeted? What do you think of Planet Labs overall? Definitely interested to hear your thoughts down below. If you haven't already, please hit that subscribe button, that like button. It always helps out so much. I hope you guys have a great week, and I'll see you in the next video. Bye for now.